How do insurance companies cover themselves from risks? Insurance businesses are often recognized for protecting individuals and businesses against risks such as disaster, cybercrime, etc. However, even insurance firms have to meet the increasing demand of the market to stay one step ahead. But there is a risk that revolves around insurance businesses. In such scenarios, insurers seek assistance from reinsurance companies. Below are some risks that insurance companies face and ways to overcome them. Strategic risk. It is the risk that involves the assessment of various processes, including the earning arising from adverse business decisions. So, in order to overcome this risk management and compliance teams should work closely. Compliance risk. It is the risk comprising of legal penalties and material loss which an organization faces when it fails to act in accordance with the industry laws. To avoid this risk, a company needs to identify theft via electronic medical records and credit card fraud with the help of the payment card companies. Financial risk. It is the risk where the outcome of an event can be measured in monetary terms. In order to avoid this risk, there are some few points that an insurance company should keep in mind. Never underprice your solutions. Don't hire until you have the funds to afford it. Don't depend on just one revenue source. Don't fill too many overhead positions. Operational risk. It is the prospect of loss resulting from inadequate or failed procedures, systems, or policies. To avoid this type of risk, the company has to maintain a strong business-to-a-business relationship and must have adequate insurance coverage. Reputational risk. This risk comprises of negative publicity and insurance policies that deal with crisis response, often including reputation damage coverage. Simple steps to manage reputational risk are: need to understand all actions that are affecting public perception. Understand stakeholder expectations. Focus on a positive image and communication. Insurance companies delegate non-core activities such as insurance policy, claims management, insurance accounting, etc. to third-party companies to stay focused on core business aspects. Insurance companies protect themselves by reinsurance. Reinsurance is a method by which they sell a portion of the policy sum insured to reinsurers and pay a premium to re-companies for sharing the risk. This is called ceding an insurance. In India, as per regulations, all insurance companies must cede a fixed percentage of their business to National Reinsurer GIC of India. Beyond this, they can cede on fixed quota share basis or surplus basis. All these are done for all the business booked by them. Insurance companies also take excessive loss insurance to cover major calamities like earthquake, floods, etc. In case of very big project, they may take specific case-by-case facultative insurance for such insurances. If they cede more, then their retained premium will be less. The turnover will come down. If they do not cede, they will be at risk in the event of major claims. The companies balance their risk exposure by studying their business and loss experience. If the company is strong, they will retain more business and do lesser re. They can also do co-insurance provided the policyholder agrees. Insurance company successful use smart method and actuarial analysis of the risk they cover. Let go by step 1. As per IRDAI requirements, they should maintain the paying capability minimum 1. 5-time risk they insured. 2. Company avoid risk which bring losses or do them at higher premiums. 3. Identify the fraud as early as possible, example fake claim, exaggerated claim, etc. 4. Co-insuring the risk. 5. Reinsurance of the risk they insured. In case of catastrophic event like flood, reinsurance help them to maintain solvency ratio. 6. Making investment as early as possible on premium.